This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend podcast. Yes, another round in U.S. politics thanks to the New Hampshire primary and an easy win for former President Donald Trump. And yet what was most on the minds of investors this past week, the big mega-cap tech companies as Alphabet, Meta, and Microsoft all hit record highs, either intraday or at the close. Microsoft, by the way, hitting a historic $3 trillion market valuation at one point. Meta hitting the $1 trillion mark for the first time since 2021. Irrational exuberance, anyone? What do you think?
I have no idea, but
Felt
you know,
that way.
it's a term that Eddie Ardeni used in a recent note, so who knows? Hey, those mega-cap tech FANG names report earnings in the coming weeks. This past week, we got results from Netflix and Tesla. Netflix sitting it out of the streaming ballpark on a key metric, and Tesla a bit more down to earth for Elon and company. More on both of those in just a moment.
Also, the first Fed meeting, check your calendars. It's just around the corner. It is this coming week. And we have a Fed insider on what the U.S. Central Bank may be thinking when it comes to monetary policy this year. And speaking of the new year, after a few rough ones, why 2024 may be the year to ride high on cannabis.
I saw what you did there.
That's kind of lame, isn't it? Curaleaf's executive chairman, Boris Jordan, stops by in our next hour.
2024 is off to a good start for Spelman College, the recipient of the largest gift in the school's history. What $100 million means with the Spelman president, Dr. Helene Gayle, and how a morning meditation starts his day from the creator of several publicly held billion-dollar and multi-billion-dollar companies.
All right, Tim. Well, all of that to come. But first, to two earnings reports that definitely got our attention this past week. Netflix and Tesla. First up, Netflix out with a blockbuster fourth quarter as the streaming service blew away Wall Street estimates for new subscribers, reporting its best quarter since the early days of the pandemic, sales too topping estimates.
Just ahead of earnings, Netflix announced its first big move into live events with a $5 billion purchase of exclusive rights to Raw and other programming from WWE. That, of course, is World Wrestling Entertainment. To put it all in context, we caught up with Michael Pachter, managing director and entertainment analyst at Wedbush Securities, who was among the analysts raising their price target on the stock. Michael, good to have you with us. Good to talk to you again. I mean, this is a company you've been covering for more than a decade, and your view has certainly shifted. Let's talk about where your view is right now. You've got an outperform on the stock. You've upped your 12-month price target to $615 from $525. Not quite a street high, but you're among the highest according to the analysts that are tracked by Bloomberg. Why the upgrade?
Well, I've covered it for 20 years in August, actually.
Wow.
We had a sell on it from roughly $10 to $6.90, so wrong for 10 years. And
Ouch.
And then I upgraded at $180, and we put it on the best ideas list at $330. So what I'm seeing is what I criticized 10 years ago or 13 years ago on the downgrade to sell. I'm seeing them do what I said they needed to do, which is stop being fixated on adding subs at all costs and start focusing on profitable subs. They're doing everything right. They're managing their spend properly. They're shifting their budget more toward television, away from movies. You saw Scott Stuber left the other day. They are shifting their budget more toward international production, which costs about half as much as domestic. They are far more international. And what you're seeing now is that subscribers are coming in at very, very high margins. You're seeing operating profits expand materially, literally 300 basis points a year, which means they're going to make a lot more money than anybody thinks in the next several years. So they trade, a 20-something multiple. We have a 30 multiple price target. Could I be at 40 or 50 or 60? Sure. It really depends on how fast.
Hey, Michael, we want to bring up a chart for all of our viewers, and it shows just the blowout number of subscribers added in that last quarter. It looks like it could, pull back a little bit in the next quarter in a big way. But as you were saying, it's not just the net number of subscribers, it's that the folks that they are signing up, they're making more money off of them.
Absolutely. And, if you see that 13 million number, new subscribers, 40% are signing up for the $6.99 ad-supported tier, but they're generating about $16 because the ad load is about $10.
Nice.
So, they've shown that by lowering price and adding advertising, they're attracting people that couldn't afford $15 before. The balance of those people are largely coming from password sharing crackdown.
Yeah.
And, there are people whose kids, their adult children or their parents.
Tim's brother included. We're just going to share that. We've shared that several times on air. Sorry, Tim's brother.
Yeah. And again, that has a double whammy. The people who shouldn't be using it are signing up on their own, and people who you want to pay for. My kids who are college grads, I'm paying for them. I pay for their cell phone. I'll pay for their Netflix subscription. So that expands average revenue per member, and it expands new members. You're seeing it all just dovetail nicely. And now they're doing something clever. They're adding gaming. They finally have figured out how to do it. And that makes the service stickier. You're less likely to quit if you've been on the Netflix service in the last month. Stuff like Grand Theft Auto Trilogy gets people coming back.
Hey, Michael, I mean, you're also a gaming analyst, we should note, so you covered this stuff really closely. What is Netflix doing that the other companies are not doing, that, the Disneys aren't doing, the Paramounts aren't doing, the Peacocks aren't doing? Like, why is Netflix executing so much better?
First mover advantage is the biggest thing. They've kind of created the fund that would buy licensed property, would license things like Suits, from the other networks. The other guys were trying to go all proprietary all the time. So CBS content stayed on Paramount, and NBC content stayed on Peacock, ABC stayed on Disney Plus, and they didn't have the critical mass to actually support giving away all that content without collecting subscription revenues. Netflix has 260 million subscribers. They can pay up. They did this for WWE. It's a perfect example of something they took away from USA Network, and now they're going global with it. Their idea is we're taking something that has an audience of fewer than 1 million people a week, and we're going to expand that to 5 million people. And when they do that, they leverage their subscriber base. They can afford to pay more. The network, or in this case, WWE, says, of course I'm taking more money. So the other guys are being dumb. Peacock, okay, right. $110 million for one game so we can all see Taylor Swift one game. Dumb. Really dumb. I know they got 3 million subscribers. All those people are going to quit in another 2 weeks.
Hey, no dissing on Taylor Swift here. Hey, having said that, Michael, that's fair. We all do. Hey, listen, we've got just about a minute left here. So you obviously are upbeat. You like the WWE deal that they just did, and they kind of front ran earnings yesterday in a big way. Having said that, what would make you turn bearish again on Netflix? And again, just got about 30, 40 seconds.
Valuation. I mean, if the stock gets to, much, much more than it's worth, of course, I would downgrade. I am very comfortable at 615. I probably could be comfortable at a higher number if I see greater earnings growth than we have forecast. But, if the stock ran to 2,000 or 5,000, of course, I would downgrade.
Michael Pachter, hey, you know what? It's okay that you pay for your kids' Netflix, okay? I'm just throwing it out there. Like, that's fine. You're not the only one who does that.
Your kids are older and you're paying for everything.
I'm just wondering if the other streaming services are going to wise up soon to, crack down on password sharing the way Netflix has. Listen, I get the sense they are, but it's going to create a lot of changes in households.
Well, talking with our Gita Ranganathan yesterday, I mean, this whole idea that Netflix has figured out how to pivot, right? From when they used to be, the little red boxes, and that you put them in the box.
The DVDs you're talking about? The little red boxes?
VHSs?
They didn't ever do it. They didn't ever do it tapes. No, they were all DVDs.
It just feels like they did.
They did pivot a lot.
All right, you've got Netflix shares, folks, up almost 12% in this session. This is Bloomberg.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
All right, Tesla to start a next-generation platform production at its Gigafactory in Texas. Teams to work on a launch of a next-generation vehicle at Texas, and continuing to make progress on a next-generation platform. So a lot of stuff that is to come. So let's get to it, because we've got a great roundtable. Red Brown is Bloomberg News earnings reporter. He covers the numbers and will give us some more insight into what we just got. Ross Gerber is with us, President and CEO of Gerber Kawasaki Wealth and Investment Management. They have about $2.2 billion in assets under management, including about $84 million worth of Tesla stock. You folks know him well. He owns Teslas. He invests in the company. He sells at times. I do want to start with you, Ross. Are you concerned? Stock's still down about 2.7% in the aftermarket, but when Tesla says 2024 volume growth may be notably lower than 2023, I don't know. Does it worry you a little bit? Does it make you want to sell any stock?
Well, I don't want to talk about our trading because I'm not allowed to, but if you look at our, my fund GK, we've been selling the stock over the last several months, as well as if you look at our public filings, we've been lowering our position over the last several months. So there's a lot of clients of mine who are very upset with some of the things Elon said and sold their stock in the $250 range that are probably pretty happy they did that today.
Ross, stick with this for a minute because you've been pretty critical of Elon Musk lately, which has been a marked difference from how you've been over the past few years. I mean, you were among the biggest Tesla bulls out there. But now you're concerned. You write that Elon's becoming the Kanye of business. Is this what's hitting the company's stock? Or is this a bigger question about what we were talking about earlier with EVs, EV demand falling, and what we're seeing from Ford, what we're seeing from GM? Is it a bigger issue outside of Elon's control?
I think Elon's created the issue for EVs across the board more than it's an EV issue. But, the bottom line is, and you see it in the numbers, and this is what we were kind of waiting to see, is that margins continue to go lower. They're basically not able to sell cars unless they lower prices because Elon refuses to advertise. And then the advertising he's doing are trips with his child to Auschwitz and, anti-Semitic and racist comments all the time. And him, basically using X as a platform for every political debate possible that he could get himself into, which is exactly how you not sell cars. So God forbid they actually got him off Twitter and advertised, maybe Tesla's problems would be solved.
Interesting. Hey, I want to bring you in, Red Brown. Things that you're seeing and noticing. We've been breaking down the earnings with our TV colleagues. The key point that you're focusing on.
Well, I think obviously the production target, notably lower volumes for next year, it does raise some questions about this strategy of continuing to lower prices. They lowered prices just last week, again in Europe, so it seems like that is going to be the strategy going forward, but it doesn't seem to be kind of paying dividends in the company's view going forward in terms of actually selling cars still.
Yeah, and Tesla less bullish on its Cybertruck, noting in the investor deck that its ramp time will be longer than for the other models given its manufacturing complexity. So it's also adding that. All right, Ross, so can definitely, respect your different tone here in Tesla. So I don't know, how do you think about this company going forward? Is it a case that it's hard to kind of remove the man and the creator from kind of the company, but how do you do that? Or do you do that at some point?
Well, what I've been saying is that the Tesla story has just changed from what the story was a few years ago before Twitter. And as long as investors are comfortable with that story, then the long term for Tesla, the story is still intact, whether it be charging, energy, EV. Tesla's the prime player in this climate change revolution that they began. And the real issue is the company is being mismanaged now by the CEO, who's demanding a massive compensation package, but won't do any of the things that the company needs to really resolve their sales and margin issues. So I think as we move forward as investors, it's really about what is the right valuation for Tesla, because Tesla's been the highest valued of the Mag 7 or one of the highest valued tech stocks for years, and before he bought Twitter, it traded 100 times multiple of future earnings. Today, it's trading at 60 times multiple of future earnings. But now that future earnings number is definitely in doubt. And does it really deserve a higher multiple than NVIDIA and Microsoft? And I think that's what's hurting the stock, irrelevant of the company.
Stock's still down about 2%. Hey, Tesla also noting, Ross, that they have reached the, quote, natural limit of cost down of our existing electric vehicle lineup. It's kind of corporate speak, but what does that mean?
Euphemism for we can't lower prices anymore?
What does that mean?
It's like we have reached maximum efficiency of production. And so basically every time we discount, it's just going to cost shareholders more. Now, the good news is this is great for Earth because people are getting cheaper and cheaper, EVs, which, are great. The bad news is it's coming from shareholders' pockets. And so if you're a shareholder, it's time to really assess, does this company deserve a 60 multiple of forward earnings? And I think that's what investors are going to be doing over the next several months.
Okay, I want to bring back in Red Brown because he's been watching the numbers come out. Red, what else sticks out to you? I know the looking at the production numbers certainly sticks out. Anything else in these numbers here? We're seeing shares down about 2% as we speak.
It's just, I think everything that we're seeing right here from the numbers is that this is kind of the cost you pay for the game that they're playing of continuing to cut these prices. You're seeing a bigger and bigger disconnect between their top line growth and their earnings growth, right? They did hit record revenue. That's going to get lost in the shuffle here today. But it came at the expense of over 40% drop in their earnings, right? So it doesn't seem like it's the path forward. I think Ross is hitting on some interesting topics here as well, as kind of where does the growth come from? A lot of the share price is predicated on some of these sort of pie in the sky initiatives, be it AI, huge question marks over that, with whether or not Elon does that inside the company or not. So hopefully get some more insights on that when the call goes later today.
Ross, what is the number one question on that call today in your view?
I think from my perspective, it's kind of what we're hitting on right now, which is where's the growth coming from? If you're not going to grow cars by a lot, like this is not a good thing. So I think my concern is 4680, and this is the story behind the story, which is one of the scaling issues they're having with cyber and semi is that 4680 is just not working as quickly as they had hoped. And they planned all of production in Texas around 4680 originally, and they've now had to pivot. And so this has caused extra costs, lots of complexity issues, and I don't think they've mastered 4680 yet, or even close for scaling at any mass level. And this is a huge detriment to Tesla moving forward because they have to get this technology right to ramp cyber and semi, which is where growth will come from.
Hey, what do you mean 4680?
These are the new cells that that they built for EVs, and these new cells are 7 times more powerful, much more efficient, charge faster, and they're wonderful, but they haven't been able to scale them as quickly as they had hoped.
All right, good stuff as always. So appreciate it. I know you've had a busy day. Our thanks to Ross Gerber, President and CEO of Gerber Kawasaki Wealth and Investment Management. And then, of course, our thanks as well to our Red Brown. He's Bloomberg News earnings reporter right here in studio. Tesla shares back down about 3.7%. We're seeing in the stock fall here in the aftermarket.
You're listening to the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We do have a headline crossing the Bloomberg terminal. The Fed Inspector General issuing its report on 2 former members of the Federal Reserve System. And we're talking about Boston Fed Chief Eric Rosengren and also Dallas President Robert Kaplan. Remember, they stepped down in September of 2021. So we're getting that report crossing. Having said that, let's bring in Bloomberg's Mike McKee because he's also seeing these headlines as they cross.
Well, I've just been reading the report, and according to the Inspector General, with regard to Mr. Kaplan, he says, we did not find that his trading activities violated laws, rules, regulations, or policies related to trading activities. His 2020 Form A Federal Reserve Bank Confidential Financial Disclosure Report did not publicly disclose the specific dates of his trading activities, nor did it specify transactions that involved the selling of stock option contracts. And that lack of information, in the Inspector General's opinion, did not support public confidence in the impartiality and integrity of the policymakers. As far as Eric Rosengren, the Inspector General found that he did not report multiple trades on his 2020 Form A. Additionally, they found multiple discrepancies between the transactions reflected in his brokerage statements and trading data and what he reported on that Form A. Moreover, in the Inspector General's opinion, they say Mr. Rosengren's trading activities in real estate investment trusts during a time of financial market volatility that prompted the Federal Reserve to authorize the purchase of agency mortgage-backed securities created a, quote, appearance of a conflict of interest that could cause a reasonable person to question Mr. Rosengren's impartiality under the Federal Reserve Board's Code of Conduct. They go on to say that the rules in effect at the time did not sufficiently support confidence in the impartiality and integrity of the policymakers. Those rules have been changed.
So net, Mike, I know this is just your first reaction, but was it a conflict of interest or merely an appearance of a conflict of interest? What's the report say?
It's hard to say exactly with regard to Eric Rosengren because it sounds like there may have been a conflict of interest, but the Inspector General does not highlight the fact that there is one. But it could appear that way. In Kaplan's case, there wasn't a conflict of interest, and he didn't violate the rules, but the fact that he didn't completely dot every I and cross every T suggests that it could have had an impact on how people think about the Fed. And that's kind of what this report, I think, is going to be saying when you read it all. It's 24 pages. I'll get to it. but basically,
not if we can help it.
Basically, it's a question of, can you trust the Fed? And that this seems to sort of say there were problems.
Well, and we have a great voice on this. Former New York Fed President Bill Dudley is with us. He's also, of course, a Bloomberg Opinion columnist. Bill is joining us on Zoom in New York. Bill, so great to have you here across our Bloomberg platforms. Can we trust the Fed based on what the Inspector General, the report that they just released? Do you feel confident about the U.S. Central Bank?
Yes, I do. I think the change in procedures as far as reporting and trading, what you're allowed to do from a trading perspective, that's been tightened up considerably in light of what happened. And I think that the regime today is, far better than what we had before.
Bill, how damaging overall over the last couple of years was this to the Federal Reserve, or at least the appearance of the Federal Reserve?
Well, I mean, anything that calls into question the impartiality of the Fed, or the idea that the Fed was somehow, people were trading on information that wasn't public, obviously that's terrible. The good thing is it sounds like this report, which I haven't had a chance yet to read, sounds like that there were no actual violations of rules and regulations. But certainly the appearance of a conflict is a bad thing because it can undercut the credibility of the central bank.
Bill, Mike McKee here. I'm just wondering if you felt at the time, if anybody felt at the time that either President Rosengren or President Kaplan had done anything wrong. The stories we have at the time suggested there was no pressure from the Federal Reserve for them to resign, but was it the right thing for them to do?
I'm not going to opine on that. What I will opine on is that you need to have a regime in place that creates confidence in the Federal Reserve System, and that regime needs to be robust. I think the thing that's sort of remarkable about this, frankly, is how long it's taken for the Inspector General to come out with these findings. I mean, it seems to me like this was something that could have been expedited much more quickly. So I'm not really sure why this took so long to become public. That's
a fair question. I also do wonder, is it a fair question to say, or fair kind of assessment to say, this should never have happened? This should have never even been a concern or cause for worry, Bill?
Well, I think there's always, with the benefit of hindsight, everything, looks obvious. I'll give you an example. When I was the president of the New York Fed, or when I was the head of the markets group at the New York Fed, there were very few restrictions on the trading activities of people within the bank. And, you couldn't do things around FOMC meetings, but, people were in possession of non-public information at other times. And the regime just wasn't very robust. And so when I became president, I changed that. I put in a much tougher regime because I didn't think that the regime that we had in place was, robust to, people were, behaving on their own, but you want something, you want governance and control above that.
I think the key headline here at the bottom line is that, according to the Inspector General, Rob Kaplan and Eric Rosengren did not do anything legally wrong. So it's more of an appearance of a conflict. Now, we also had issues at the same time with Jay Powell and Richard Clarida. Is that, do you think, behind the Fed now? Is this, you mentioned how long it took to get this report. Is this sort of ancient history and the Fed's moved on?
Well, I think it's ancient history in the sense that the Fed's changed all the rules. You can't do these things now that you could have done before. That's the same thing that I did when I was the president of the New York Fed. I basically said, this is a regime in place that allows too many things that could potentially happen that could create the appearance of conflict. Let's just tighten this up a lot so there's no question. There's no question, there's no risk. And I think that's what the Federal Reserve has done. So I don't think there's much risk of anything happening in the future. But, it would have been nice if you had tightened up the regime before this happened rather than after.
All right, we're going to pivot a little bit because the reason we really initially wanted to talk to you was about what the Fed does next. And we're looking at the markets where we had another record on the S&P 500. Investors continuing to embrace maybe this risk on trade on expectations, Bill, that we're going to have a pretty aggressive Fed. And they're pricing in, or it seems to be pricing in, a fair amount of Fed rate cuts this year. What are you seeing when you look at the markets, and what do you think Fed officials are thinking and seeing when they see the move up, especially on the equity side of things?
Well, I think the reason why the markets are doing well is because the probability of a soft landing has gone up. I mean, what's basically happened is the economy's continued to grow, and that's kept the labor market tight. But the tightness of the labor market is not leading to acceleration in wage inflation or an increase in ongoing prices for goods and services. So it's sort of like the best of all worlds. So we had we brought inflation down without much.
Are you saying Goldilocks? Are you saying definitely a soft landing here?
So far, no, not at all. So far, so good. So I don't think the story has been fully written yet, and we'll have to see where we go. I mean, it's very difficult for the Fed to generate a soft landing because you basically need growth weak enough to keep the economy from overheating, but strong enough to keep the economy out of recession. And that margin for error right now is very, very small. So I think it's really too soon to conclude that we're on this golden path. But the chances of a soft landing definitely have gone up, and that's what the market's reacting to.
A month ago, you wrote a column for Bloomberg Opinion that said that the pivot is a pretty big gamble and that there's a significant chance there won't be a soft landing. Would you say there's still a significant chance? Or if not, what data has come in to show you that there is a better chance of a soft landing?
Well, I think there's risks on both sides. Number one, monetary policy might not be as tight as the Fed thinks it is. And if that's the case, the economy keeps growing, the labor market stays tight, and we don't get inflation all the way back to 2%. And so the Fed Reserve, that's sort of the no landing scenario. The other scenario, of course, is that the Fed keeps monetary policy a little too tight for too long. The labor market deteriorates, and once the labor market starts to deteriorate, that usually tends to be fairly sizable rather than small. The SOM rule says every time the unemployment rate goes up by more than 0.5%, you have a full-blown recession. So, the Fed is trying to find the exactly right guide path. And, when Powell, does his press conference next week, everyone's going to ask him questions about what are you going to do in March, what are you going to do in May? And the answer is they don't know at this point because the economic information is going to tell them whether they're on the right glide path or not. If the economy is weaker than expected, the labor market has more slack than expected, then the Federal Reserve will cut rates sooner and by more. If the economy is stronger than expected, and inflation stays a little bit higher than expected, then the Federal Reserve will keep monetary policy on hold. And relatively small differences in the growth trajectory right now are going to have pretty big implications for the interest rate path. That's why the market's very volatile. It's reacting to each piece of incoming information because each piece of incoming information affects the probability of these three different outcomes.
Bill, we're talking a lot about politics these days with the primaries and caucuses underway. And I'm wondering, question I know the answer to, your basic answer to. If I ask you, will politics of this election year play into Fed decision making, you're going to tell me no, the Fed doesn't let that happen. But we know from the transcripts that it gets talked about. And given the fact that one of the candidates has said a lot of nasty things about the Federal Reserve, would the Fed prefer, if it knows it's going to be cutting interest rates, to do it before the September meeting to sort of stay out of the headlines of politics?
I think at the end of the day, the Federal Reserve will set monetary policy on what they think is the right formula to generate the best possible combination of full employment and price stability. The Fed can't pay attention to politics because if they start to pay attention to politics, that politicizes the Fed and makes the Fed vulnerable to attack. This is why Chair Powell, when he's asked about fiscal policy, tax cuts, and things of that sort, he never wants to talk about any of those things because he doesn't want the Fed involved in the political debate. And so I think the Fed will stay very apolitical. My own experience, I was at the Federal Reserve for 11 and a half years around the FOMC table. Never did politics come up as a reason to adjust monetary policy either more slowly or more quickly.
But Bill, go ahead.
I was going to ask, did you ever feel any sort of internal pressure as a human being, thinking about what your decision might mean in the context of how voters react?
I think at the end of the day, you just have to be blind to that. I mean, I think the only way it might come up is there have been cases in the past where the election's been right after an FOMC meeting. So maybe that FOMC meeting that's a couple days before the election, maybe that's one that you take a pass on. But that only occurs every once in a while because a lot of times the meeting happens after the election. The election's the first Tuesday in November, and the Fed has an FOMC meeting around that time. And where that FOMC meeting falls could maybe have a very, 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 very marginal effect. But I think beyond that, I think there's just nothing there because if the Fed starts going down this path, where does it end? Then the Fed gets accused of being political. Then people start to talk about, maybe we need to rein in the Fed's independence. Fed loses independence, then it loses its ability to conduct monetary policy in a way best designed to achieve its dual mandate objectives. So it's a slippery slope. You don't want to start going down that slippery slope.
But safe to say, Donald Trump, if he is, and everything is pointing to him being the Republican presidential candidate again, if he, he's not been shy about his feelings, certainly, about the Fed and Jay Powell specifically. Should Jay Powell and Fed officials worry, though, possibly about becoming part of the campaign, whether they like it or not?
Well, it wouldn't surprise me at all if, the candidate Trump started to attack the Fed for cutting interest rates, arguing that was somehow aiding the Biden, reelection chances. So that certainly could come up. I mean, that wouldn't surprise me at all. But the Fed Reserve would be, no, we're doing what we think is appropriate to achieve our dual mandate objectives.
All right. So your best bet, and we totally get it, data dependent. We're going to move from data point to data point. Having said that, are investors' markets not being smart and not including in their thinking that the Fed could actually raise rates again? Or how do you think about that?
Well, I think the likelihood of the Fed raising rates from here is very low. And I think the reason is that Fed already thinks monetary policy is quite restrictive. So they would have to be convinced that monetary policy is not restrictive. I think if it turns out that the economy is stronger than expected, inflation's higher than expected, it's more likely they just stay at the current level for longer, as opposed to move to actually start to hike rates again. I think the bar to raising rates at this point is pretty high.
Why does it seem to you that the dot plot kind of shows that Fed officials are all over the place over the next couple of years? What kind of uncertainty does that suggest? Does it suggest that there are real camps of doves and hawks?
I think that this is just a very uncertain outlook. I mean, how many times have we had recoveries from pandemics and the economy having lots of inflation with the Federal Reserve being very slow to tighten monetary policy? And so that's sort of the bad news. And then the good news, it seems like it's working out pretty well so far. So the Fed has caught up. Economy has slowed a bit. Inflation's come down. So I think, the reason why, it's just a very tricky environment. I think that, Fed officials probably disagree mostly about the economic outlook, the uncertainties about the economic outlook. I think in terms of how they would respond to the same economic outlook, I imagine the reaction function, how they would respond, probably doesn't vary as much. But I think it's mostly uncertainty about the economic outlook.
Hey, Bill, just got about 1 minute left here. We're getting ready for a read on GDP here in the United States. That's later on this week. And then, of course, the Fed meeting next week. What do you think is the smart conversation, smart thought, or smart metric that you think investors should be watching ahead of all of that to kind of figure out where we go from here?
Well, I think the GDP news is sort of old news. It's like describing what happened in the fourth quarter, and that's really not really that important from the Fed's perspective. It's really where are we going from here. Right. So I don't think the GDP news is going to be very, very important in terms of influencing the Fed. I think what's really going to be important is, number one, what happens to the labor market, what's happening to payroll employment, what's happening to the unemployment rate, what's happening to wages, and number two, what's happening to inflation. Is the final mile on inflation actually going to be harder or not so hard? That's really the question on the table.
All right. Well, Bill Dudley, so appreciate your time on this Monday with the breaking news. And then, of course, getting your outlook and thoughts on the U.S. Central Bank. Bill Dudley, of course, former president of the New York Fed, Bloomberg opinion columnist, and, of course, our Michael McKee, who covers the Fed and everything going on with interest rates. Bill, by the way, will be part of the Bloomberg Radio and TV special on the Fed Decides. That's on Wednesday, January 31st. That starts at 1:30 p.m. Wall Street time.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Well, a billionaire couple is giving $100 million to Atlanta's Spelman College, which the women's school says is the largest ever single donation to a historically black college or university. The donation announced yesterday by Rhonda Stryker and her husband, William Johnston. She is the billionaire granddaughter of the founder of medical device maker Stryker Corporation. He is the chairman of money management firm Greenleaf Trust. They live in Michigan.
Spelman said it would use $75 million to endow scholarships. The rest of the money will be used for other purposes, including developing an academic focus on public policy and democracy and improving student housing, a sore point in recent years among Spelman students.
We are so delighted to have with us to talk about this historic gift in what it is a historic year for Spelman. Dr. Helene Gale, she's president of Spelman College. She is on Zoom from Atlanta, and also with us, delighted to have here Bloomberg News higher education finance reporter Janet Lauren in our Bloomberg Interactive Brokers studio. Dr. Gale, congratulations. Thank you for giving us some time here. Can you talk to us a little bit about how this gift came up? How did Rhonda Stryker come to be a trustee at Spelman? And what's it like to receive the news of a gift of this magnitude?
Well, thank you, and thanks for having me on. Well, Rhonda Stryker is one of our longest-serving trustees. She was brought on by one of my predecessors over 20 years ago. And over the years, she and her husband have continued to contribute to Spelman and, have been incredibly generous donors. But this is clearly the largest single gift that they have ever given. And as you said in the run up to this, it's the largest single gift that Spelman has ever received and the largest gift to any HBCU. So it's pretty exciting and, truly a transformational gift that I think can make such a huge difference for Spelman, not only now, but far into the future.
So thank you again for coming. So tell us, how does this donation impact your endowment's longevity, especially when it comes to scholarships?
So, we plan to use 75% of it for endowing scholarships. We will obviously put that money to work immediately, and in a year or so there will be returns that we can use to start increasing our scholarships already. But as you know, endowments really what you can do with an endowment is to think about future generations. And so, we look at this as the way that we can secure the future for bright, talented young women who want to get a Spelman education, but oftentimes are not able to because of financial barriers. So, we think this is going to make a difference for our students today, but also for the students of tomorrow.
Well, and I was looking at your most recent value of June 2022. It was less than $500 million. And then this gives you a huge amount of money more to invest. Can you talk about what that means for having, having that in the fund and to be able to build on it and to be able to do things like help students graduate and boost those rates and, help them return the next semester if there's trouble?
Yeah, no, totally. That's exactly what, we hope to be able to do. As you stated, we have an endowment that's just under $500 million. That is large for many of our HBCU colleagues. But, when we compare ourselves to similar schools, similar size type and similar types of populations, our endowment trails many of our peer institutions. And so, we think that this, which is a huge increase in our endowment, will be able to provide scholarships for students. As we have a high need population. We've got brilliant students, grade point averages that range 3.9 and above. But we also have a high need population. 40% of our students are Pell eligible. About 80% of our students get some sort of need-based financial aid. So, we want to be able to bridge that gap between the talent that we see walking through the door and the, real gap in financial resources. When you can take this incredible talent pool and match it with the resources that allow them to have this kind of life-changing education, I think we can make a huge contribution through this gift and, hopefully many more. We hope that this is the kind of gift that will inspire others to invest not only in Spelman, but other HBCUs.
So, I want to talk a little bit more about the cost of higher education, because we got some news earlier today that President Biden is continuing with his efforts to try to reduce the debt load that Americans have. Whether or not that is successful remains to be seen. But the cost of higher education at your school is $46,000 a year for a student living on campus. I got to tell you, that's a relative bargain in this day and age. We were talking with a colleague recently who about another school, not an Ivy League school, a small liberal arts college, over $90,000 a year. Why does the cost of higher education continue to be so high, Dr. Gale?
Well, every school is different. We've tried very hard to keep our costs as low as possible. In fact, we reset our tuition and fees a couple of years ago to be able to try to make our education as affordable as possible. But, costs continue to rise. Employment costs continue to rise. We have to be able to attract the kind of high caliber faculty that attracts the student population that comes to Spelman. We've got to make sure that we pay our staff and administrative support the kinds of resources. And so, a lot of the cost of a college or university are the personnel costs that continue to go up. But we also know that construction costs, other supply costs have all continued to go up. So, we try as hard as we can to manage those costs, to not have to increase tuition and fees, but we also have to be competitive in today's market.
But does it feel a little crazy when it's almost $100,000? I'm just... you understand this world.
I think we've got to work on both sides. We have to work on making education more and more affordable, but we also have to look at how are we making sure that students do have the kind of resources, access to scholarships, access to low-cost loans to be able to afford education. So we've got to work on both ends, and we've got work to do.
Right.
So I read a lot about fundraising, and I would love to hear, how does a gift like this come about? It must have you must have been working on it for years and years. If you could take us through that, and also what's it like to get the nod? Yes, we're giving you $100 million.
Well, as I mentioned, Rhonda Stryker has been a long-serving board member, and she has seen the transformative nature of a Spelman education. We have young women who walk through the door, without, as young women, and whose lives are transformed by the education that they get here. She has seen the economic value that occurs when a young girl comes in the door, leaves, ready to go out into the workforce. If you look at the statistics, HBCUs like Spelman have punched above their weight for so many years. And I think she has seen that the value of investing can make such a huge difference. And so, gifts come because people believe in your mission. People who have resources, who believe in your mission, have the opportunity to experience why it's so important to invest. So Rhonda Stryker has had the opportunity to see what it means when you can match the talent pool that we have with the kind of resources that can be transformational and change lives. Spelman College has the product of Spelman College is obvious. We could rattle off the names of important leaders in business, in policy, in politics, in arts, entertainment, entrepreneurship. And so we know that there's a product that comes from Spelman that changes lives.
Well, thank you so much for finding time for us. Congratulations. We know it's also an important anniversary for you guys and the official naming of the school. So congratulations on that. Dr. Helene Gale, president of Spelman College, and of course, Bloomberg's own Janet Loring.
You're listening to the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
plenty ahead in our second hour of the weekend edition of Bloomberg Businessweek, including time to get high on the cannabis industry. I'm asking, and I'm really sorry I had to go there.
How many of these puns do you have?
It's the only one I have with cannabis. How lame am I?
You did one earlier. Meantime, plain old booze doing just fine, it seems, especially if you want it delivered right to your doorstep.
Who doesn't?
Derek Correa is CEO of Reserve Bar. He'll join us with a business update and adapting to changing drinking habits as younger generations are drinking less and older ones are drinking more. And a lot of people, Carol, just seem to be taking part in Dry January.
I'm amazed at the people who come into our studio and yeah, I'm part of it. And
I know you offer somebody like, oh, let's go for a drink. They're like, no, I'm doing Dry January.
A lot of them work here, by the way.
What does that say?
I don't know. First up this hour, the CEO who meditates before getting down to business. And he does have a lot of business going on. Brad Jacobs is the founder and chairman at freight services provider XPO.
He's a serial entrepreneur. Brad has started 5 companies, and he's the author of a new book just out this week, How to Make a Few $1 Billion. A lot to talk about, and we kicked off Brad being back in our studio by getting his take on today's business environment.
I think we've started to see the economy slowing down, for sure, here and in Europe. I think it's going to continue to slow down. And depending on what the Fed does, it could start picking up. But it depends on what the Fed does.
Is that more an issue of what the Fed does versus the wars overseas, and we're looking at the Red Sea and ships not being able to go through? We're worried about, does the supply chain already, have some problems in it, and maybe it even gets worse? Is the Fed more important, and really global central banks?
The Fed is more important than what the Houthis are doing. The Houthis are driving, the Houthis, if you want to look at it in economic terms, are inflationary because they're driving up shipping costs, which will be passed along to consumers in the end. But the Fed is the overall stimulator or slower downer of the economy.
So that's more important. Yeah.
Well, there is the big debate that we talk about every day is like, will they or won't they in March cut rates? You say the economy is dependent on what the Fed does. What do you think the Fed should do?
I think the Fed should keep looking at the data and ignore everything else and go by the data. If inflation cools down more, then it may make sense to start lowering rates. If inflation continues to rear its ugly head, then it's not the time to be lowering rates.
Are you seeing in your various businesses what you're hearing from colleagues, what you're hearing from associates? Is inflation rearing its ugly head again, or does the Fed have this tamed?
It's more slowing down and having slowed down than inflation coming back. So I look at wages a lot since it's a big part of all of our businesses.
Yeah.
Wage growth has slowed. Input costs are still going up, but they've slowed. Rents, lease has gone up, but they're going up slower. So it does feel it's slowed down quite a bit.
Brad, are you holding on to workers?
Yeah, much more than, well, first of all, we couldn't even find workers a couple of years ago.
Right, but I'm just curious, are you still worried about like losing someone and not being able to, or letting somebody go if you're starting to see some softness? Would you rather hold on to a worker at this point?
Well, you always want to hold on to your talent. And in the book, I talk all about that. That your number one asset are your people, and you got to make sure you have A+.
But you know what I'm saying, that when you run a publicly held company, and if you're worried about any kind of slowdown, you've got to start to look at your costs again. And workers certainly play into it.
And you should be looking at your costs in every part of the cycle. You should be managing your costs intelligently.
All right. So having said that, when you think about capital expenditures, you're comfortable to move ahead?
Yeah, absolutely. I'm about to start a new company.
You have started a new company?
Yeah, well, almost.
Almost. Well, where are you with that? Help us out with that, because we've talked about it with you last year. We're talking about QXO.
Right.
Tell us about where you are. And you're looking to buy businesses, from what I understand. It's all about kind of moving businesses or materials around in North America. So where are you in the process?
North America and Europe.
And Europe.
So it's I did exactly what I said I was going to do when I saw you last time. So we've agreed to put $1 billion pipe, equity investment into a very small cap company. We're then going to spin that company back to its legacy owners, give them a $2.5 million dividend, give them a small, less than 0.5% of equity ownership in our new company, QXO. And we'll have a pure play called QXO, which will consolidate the $800 billion building products distribution industry.
So where are you in the process?
We're a couple months or so away from finishing that.
Yeah.
And depending on various approvals we have to get from the SEC and so forth. And then we'll be off to the races.
So you haven't acquired anything yet?
Correct.
But do you have like a list that you're ready to go?
Oh, yeah. We're talking to lots of companies.
Okay.
We have a lot of discussions going on.
Privately held, I'm assuming? Smaller players, mid-sized players?
Well, for right now, because our budget is only $1 billion,
right.
they're all private.
Okay.
How are you going to make 1 + 1 = 3 with these acquisitions? Like, how will you bring operational efficiency?
I'm going to follow the same exact playbook that I've done for the last few decades. I'm going to buy companies that are good companies, but can be better. I'm going to buy companies when you put them together, you find synergies, particularly in procurement, which is the biggest line item in building products distribution. I'm going to apply technology to be the most tech-forward building products distributor in the world. And I'm going to do all that together and get economies of scale as we get bigger and bigger and bigger. Now, I've put the numbers out there. I expect to be at least $1 billion revenue run rate after year one, at least a $5 billion revenue run rate.
So you're sticking to that?
Absolutely. And most importantly, tens of billions of dollars of revenue over the decade.
Why is this such a smart bet right now? This of distributing building materials in North America and Europe, you said specifically. What's the trend that you are seeing? Is it infrastructure? What is it?
Long term, there's 3 drivers. In residential construction, houses are old. Their average age of a house is over 40 years, which is old. So, and there's repair and remodeling going on, and there's more construction that'll be driven by that. They're on the non-residential construction, they're even older. Non-residential buildings are over 50 years old on average. On the infrastructure, there's about $2 trillion of infrastructure spend that needs to be done over the next 20 years. So there's a lot of activity that has to happen here.
Why not just relax?
I'm relaxed. Do I not look relaxed?
Can you hear this, babe?
Why not just
am I relaxed?
I mean, like, what motivates you to keep doing this? Like, you've been successful many times over and over again, and I mean,
I love the job. I've been a CEO since I've been 23 years old. It's just a fantastic job. You get to be very creative. You get to think big. You get to dream these large, large business plans. You get to recruit people you love to work with. You design compensation programs so everybody's in it to win it. And you come to work every day and you just knock down a list and make it happen. And you create huge amounts of money, not just for the employees, but for the shareholders. You know, our companies over the years have really excelled at shareholder value creation. If you looked at XPO Logistics, our initial investors made 32 times their money. If you look at United Rentals, we started, it was $3.50 a share. Today it's over $550 a share. So it's, a lot of value has been created for a lot of people, and I just love that. I take a lot of pride in that.
This value creation of maybe $1 billion, you say, of annual revenue in the first year, and then $5 billion within 3 years. Can you do that if there's any weakness in the global economy or in the U.S. and Europe?
I can do this business plan regardless of what happens in the economy. If it's strong, if it's weak, if it's flat, I can still do this business
Why?
plan. Because there's 7,000 distributors to buy in the United States, in North America, including Canada. There's 13,000 to buy in Europe. There's a lot of them are owned by private equity, and private equity will have a choice. Private equity can dribble out over a number of years through an IPO and a secondary and so forth at a discount, or they can sell to me on a win-win deal where I pay them a premium.
So, like, when you wake up in the morning, what's the first thing you think about?
First thing I think about is how to get my head in a good place.
Okay.
Before I start getting into business. How do I center myself?
Really?
Yeah. I do a series of meditation exercises to expand my mind and to think about very large areas of space. And then I try to shrink it into very small, like down into atoms. And I have a whole spiritual exercise I do in the morning.
I love that.
I get in the zone. I like to get in the zone.
Is that different than when you were 23 and you were a CEO?
A little more now. A little more now. I was doing it then. Yeah.
That's interesting. Because I do feel like these days to hear an executive say that is not that surprising. It's widely accepted that is a way to actually.
I was
get
in the closet
centered.
when I was in my 20s.
Okay,
on that.
But
we kept the meditation stuff quiet.
Yeah, but at the beginning of your career,
yes,
that's interesting.
Yeah, that is interesting. Why did you start then? Like what?
I started transcendental meditation when I was a teenager in high school.
Yeah. And
then I did that for decades. I did that for a long time. And then I started experimenting with other forms of meditation. I studied Milton Ericksonian hypnotherapy. And I studied psychotherapy, the different mindfulness techniques, the cognitive therapy techniques. And I kind of blended them all together and picked and chose, and I made my own thing.
Well, why?
Because I think, as I say in the very first chapter, you need to rearrange your brain in order to accomplish big stuff.
But what was the awareness that you had in high school to actually do that? You don't meet high schoolers
I saw a poster
who do this.
of Maharishi Mahesh Yogi up on a screen. It said something like "Life is bliss." I said, "That's interesting. I think I'll go to the lecture."
Do you do yoga too?
I do yoga.
Yeah. Interesting. That is really fascinating. All right, so I'm like getting my head around that. Love that. So with this book, and I know we've talked about it before, I mean, what are you trying to inspire in other people, knowing what you've done so far and kind of laying this out? Because the title makes it feel like, hey, anybody can do this. I don't know that anybody can do it. Are you saying anybody can do this?
Depends what this is. I don't think anybody can make a few $1 billion because that's just mathematically, there's only a few people who do that. But I think anybody can rearrange their brain to think in a different way that's big, that's confident, that's strong, that's very off the beaten track, and accomplish great stuff. Now, that doesn't have to be making money. That can be all kinds of stuff. That can be just being a great mom or dad. Right. That can be a great artist. That can be a great musician. It can be a great anything. But yes, I think what I've shared in the book are the techniques that have worked for me in order to attract great people and to organize those people in a way to accomplish big things. And I think that can be taught.
One of the things I think about is, to be fair, like we'll have a lot of leaders in and talk about great people. But what is it that you think really people have to understand? What does that mean? Is it allowing them, like we talked about the Smucker CEO, and that company is allowing people to come to work, Tuesday to Thursday every other week? Like,
that's not my culture at all.
But what is it to create great people? Like, what does that mean? How do you do that?
You need to think in your mind very clearly who you're trying to attract. What are the traits and qualities and characteristics that you're looking for? I know what those are very clearly for me. I look for people who are super smart. They've got to be smarter than me. Mm-hmm. Why do I want to depend on people less smart than me? I want to depend on people smarter than me. So I always try to get people who are hopefully significantly smarter than I am. They may not have this. I bring certain business talents and commercial sense to the table, leadership talents. But in terms of raw IQ, I like smart people. I really, really enjoy that. I want people with grit. I want people who are hungry, who want to work really, really hard, who actually like working, who's enjoyable. And then I want people who are honest as the day is long. I definitely don't want people who I'm trying to analyze what do they really mean.
Yeah.
I want people who are collegial and collaborative and team players and play well in the sandbox with each other, so that you can create, well, if you're an ant or you're a bee, a superorganism. I talk about that in the book. You want to create a culture that's a superorganism, not just a bunch of people, but a highly integrated group of people.
Is there a leader you admire?
Oh, lots of people. Yeah.
Is there one that you would share?
I admire Jeff Bezos. I admire Elon Musk, even though he has certain traits I don't admire. But I do admire his ability to think huge.
You brought up Elon Musk, so I want to go somewhere that Carol and I go each and every day, which is, some people argue, the biggest revolution when it comes to technology right now, and that's what's happening with AI. Certainly a lot has changed when it comes to computers and AI over your career. How do you think about harnessing AI, using it in your businesses, and even concerns that you might have about the technology?
I've always used technology to my advantage. All my companies have been tech forward, right from the very first one. So when I was in the oil business, way before the internet, our main edge was to have a rudimentary technology system to collect information globally about buyers and sellers of crude oil and refined products. When I was in the waste management business, we were the first ones to pioneer very advanced route optimization software. So the trucks weren't just randomly driving around, we were efficiently optimized what the routes were going to be. When I was in the construction equipment rental business, one of the first acquisitions we made, and we made hundreds of acquisitions, was a company called Win Systems, which was a way to record where all the equipment is, and we had billions of dollars of equipment, where everything was at any one point in time, and to predict it and monitor its utilization so that we could replenish the fleet where we needed it, where there was demand, and we'd know where to lower prices or raise prices depending on demand. XPO was all about technology. One of the first few people I hired was Mario Harek, now the CEO of XPO, who as my CIO, because the vision was to automate truck brokerage. Mm-hmm. And fast forward to today, we've spun that off as RXO. Drew Wilkerson runs it. And 98% of their orders are either sourced or covered electronically. That was 0% when we started the company. So yeah, I've always embraced technology. I think it's really important to do that.
Only have about 30, 40 seconds left here, so I'm going to ask you, but you say bigger is better in business most of the time, but not always. And I think in a world where we're always like wanting more, we even talk about companies, look at this market cap, they're number one. Why is this an important concept? And forgive me, Brett, because we only have about 30 seconds.
So over the last year, I've looked at dozens of industries and hundreds of companies, and I had a checklist of everything I wanted. Size, growth, fragmentation. One of them was bigger is better. That means there's economies of scale. In the case of QXO, the big economy of scale is purchasing power, procurement. Because if you buy lots of materials, you're going to get a cheaper price.
Promise you'll come back and as you build out your new business?
I always like to come on here because it seems like it was 1 minute.
I agree. And we learned something new about you, which was really fascinating. Brad Jacobs, thank you so much. Good luck with everything. Founder and chairman of XPO, of course. We've talked about his new book, How to Make a Few $1 billion, and looking forward already to the future conversation. Be well.
Thank you.
You are listening and watching Bloomberg Radio.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Investors not so keen on the cannabis sector last year. The advisor shares pure U.S. cannabis ETF little changed in 2023 after dropping 73% in 2022. This year, however, as a whole, Tim, the group is up about 20% as measured by that ETF.
We have seen the group pop this year as investors seem optimistic about a possible reclassification and potential regulatory changes that could benefit the cannabis industry after the Department of Health and Human Services released some 252 pages of documents asking the DEA and to ease its position on cannabis. We're talking, of course, about the Drug Enforcement Agency.
Right.
This, according to Bloomberg News over the summer.
Yeah, a lot of pages. What's key, and for the first time, the HHS recommending that the DEA reschedule cannabis from Schedule 1 to Schedule 3. It gets a little wonky under the Controlled Substances Act, but it's significant. To do this, HHS had to find that cannabis had acceptable medical uses and a relatively low potential for abuse and dependence. Many people reporting, the Wall Street Journal kind of noting this out specifically as to why this is so significant.
Yeah, net, the HHS recommending sweeping changes to federal marijuana laws, and yet we've seen this industry high before in societal norms and politics. Have their say politics a big part of this?
Absolutely. So let's get more on the industry. We welcome back Boris Jordan. He's executive chairman at Curaleaf, here with us in our Bloomberg Interactive Broker studio. Curaleaf shares, by the way, they're up about 17% year to date after 3 down years, with the stock losing more than 70% since a high on February 10th, 2021. We know it's been tough going, but much different tone this weekend, this year, I should say. Boris, first of all, Happy New Year. Good to have you back in the studio.
Great to be back in the studio.
You walked in, this is the first time since COVID, right?
Yeah, first time since COVID back in the studio.
All right, talk to us about the mood this year. We got a little wonky in terms of what is going on with regulators, the DEA and HHS, but this is significant potentially.
This is literally a game changer. I think that in many ways, if you read it, and I actually spent a couple of days reading 250 pages, and the thing that I took out of it the most is this was largely an apology, almost by the federal government, about cannabis.
What do you mean by that?
For the last 50 years. Well, because if you look back at it, when they scheduled cannabis to Schedule 1, there was a tremendous amount of papers written on how awful it was, how terrible it was for your health, that there were no medical benefits, that this was the root of all evil. And if you think about it, today, not even drugs like cocaine or fentanyl are Schedule 1, right? Things that actually kill people. I mean, alcohol isn't even scheduled, which has a lot worse effects on the human body than cannabis does.
So it's basically a classification, right, of these substances?
It's a classification, and I think in many ways they're also, not only are they following the people in the country, the fact that, 80% of the country now has access to either medical or recreational cannabis and is frankly using it, but also you have major countries like Canada and Germany. Germany, on the 22nd of February, is going to be voting to take cannabis off their narcotics list, not rescheduling from Schedule 1 to Schedule 3, but taking it off completely. So you have major countries around the world that are starting to recognize the medical benefits of cannabis and are taking it off the list.
Is Germany's approach the right approach, in your opinion?
I personally think, every country has its own approach. I think for Germany, they have decided that that's the right approach. They want to take it off. And what that allows them to do, in Germany at least, is that all doctors will now be able to prescribe cannabis. And more importantly, today in Germany, under their current law, you have to try other drugs before you can try cannabis. So now that won't be the case. You can go use cannabis as a primary drug, and you can have any doctor prescribe it under the new legislation.
So what about the timing for the potential DEA rescheduling of marijuana? Boris, how are you thinking about it in terms of timing? Do you have any clarity on that? Because I'm reading upbeat stuff, but they're also saying slow it down, everybody.
Yeah, I think what you said in your introduction was right. I think this is very political now. We are going into political season. This is something, particularly with the Democratic Party, to get out the younger vote. The younger vote is very much pro-cannabis. We all know they're using a lot more cannabis than they are alcohol. Alcohol sales in all states where cannabis is now legal are down, 10 to 15%. So this is a real vote getter potentially. And so I think this is going to be tied to politics. If that's the case, if we're right on that, then the latest they can really come out with this is mid-April. And the reason for that is you have to have a 60-day comment period after the recommendation.
Right.
And then you have to have 60-day legislative period. 60-day legislative, under our calculations, about 3 months before it can become active. And so that means if they want it active before the election, if this is really political in nature, then they really the latest they can do this is really April. However, if it's not political, then they can take it out 9 years. I mean, we've seen that before too.
Which one do you think they'll do?
I personally think that they wouldn't do all of this if this was going to be, a 9-year thing. I think that they are going to probably make the recommendation to reschedule sometime in the next 3 months.
All right. So if that happens, what does it mean for Curaleaf specifically? What's the all of a sudden?
For Curaleaf, it's an absolute game changer for a variety of reasons. For instance, on 2024 numbers, we would pay an extra $200 million cash in taxes to the federal government over and above our normal corporate tax rate, which would be equal to everybody else's. So largely the cannabis industry, and one of the reasons that these stocks have been down is people have realized that the cannabis industry is working for the federal government. Anything we make gets paid out in taxes to the federal government. So we can virtually not produce positive numbers on the bottom line.
So explain that.
Because our effective tax rate is over 70%. And the reason for that is we cannot write off any expenses, which is, by the way, really bad for benefits for employees. Anything we try to do for employees we can't have IRAs, we can't do anything because of this tax system. And so, today we can't write off any expenses. So that brings us to an effective tax rate of 70+% is what we're paying.
How do you run a business like that, if that's the case?
That shows you how well these companies are actually run. The fact that they can actually survive in an atmosphere where we're paying 70+% taxes.
Okay, beyond the tax benefits, which I know you've talked about in the past and have been well documented, how do you pivot your business into new areas? Do you start selling things differently? Do you start doing things differently, unrelated to taxes?
So a lot will depend, and this is the big unknown, a lot will depend on what the DOJ says after this rescheduling. So we're expecting a DOJ memo. The code word for it is called the Garland memo. That's going to come out very similar to the Cole memo under Obama, which will then describe what they mean by this rescheduling. Like, what are the rules going to be in the marketplace? And there's a lot of unknowns because at the moment the states control the regulation of cannabis, right? It's still federally legal. Rescheduling doesn't make it federally legal. It just reschedules from Schedule 1 to Schedule 3. So now we need to see what is the DOJ going to say on the back of that. We also have safer banking that's going through Congress right now. It's now in joint committee. Many people don't realize that.
My entire career has been.
I'm just going to say.
Right, but it's been a big.
How many kids have you had since we've been talking about this?
It's literally, I've been looking at this for 10 years. I'm just as frustrated. But I will tell you what I learned last Friday. This is absolutely in joint committee between the Senate and the House. That's never happened before since the beginning. They are now negotiating aspects of that bill, and they're looking to bring it in March. I believe that's also part of the coordination.
So you're not worried about November elections in terms of how that plays out and could affect this, because you think a lot of it's going to be done prior to that?
I think they're going to try to get a lot of it done prior to that. I mean, we have two candidates right now that are front runners that are both anti-cannabis. Let's be honest, both Trump and Biden are not necessarily pro-cannabis. And so a lot of this that's happening today is happening by the Biden campaign and by pressure because of the political situation. Even against all the lobbying by pharma and interest groups that are against cannabis, this thing is really starting to gain traction.
So tell us a little bit about your business and what people are buying. Are we moving beyond flower and buds? Are we moving into vaping products? What are you selling the most of right now?
I have to say the industry has really matured. If you take a look, and it's different in the U.S. and Europe. Curaleaf is the only company that's got U.S. company that has a very substantial presence in Europe. We're selling cannabis in 4 different countries in Europe. And in Europe, it's very medical. It's almost pharmaceutical in nature.
Right.
So we're selling a lot of formulated pills. We're selling a lot of products, but also flower. And flower is very popular with doctors in Europe as well. In the United States, there's a much broader array of products. It's much less regulated than it is in Europe. And so we sell a whole assortment. One product that's really gaining, and I said this a year ago, is drinks. Drinks are really starting. Seltzer waters are really starting to gain. Iced teas with cannabinoids.
So is that where the growth is, Boris? But what is still
the growth is definitely in products, but flower is still the door opener.
The bulk of your business.
Yeah, the 50% of our business is flower, and for all cannabis company. But when I started, it was 90%.
Right.
And today it's 50%. So that 40% has largely been formulated products.
So it stayed constant. Everything else has grown?
That's right.
Or that's gone down?
I think the whole industry has been expanding, so I would say that's right.
Okay.
I'm wondering about your thoughts on the rising concerns over high-potency THC products. Addiction associated with that, psychosis associated with that high potency. Is there any sort of threat when it comes from a regulatory perspective in certain states about potency caps?
So I'm going to get criticized from the industry by my comments. I'm wholly in agreement that there needs to be regulation around potency. That's my view. I mean, we run the largest company in the world in this area. We want to be the responsible company to push this. I personally think that there should be potency caps. I actually think that the THC is not the most important part of the product. I think a lot of the terpenes on these products are actually more important in terms of entourage effect than THC.
Meaning those other things are the things that make people have the feelings of being high?
Or relaxed, or working with anxiety. Like, we're doing a lot of R&D right now in cannabinoids outside of THC that are in the cannabis plant. I think that, for the most part, the evidence of addiction on THC is really anecdotal. There's no real evidence that THC is addictive.
The psychosis part, though.
But the psychosis part is a problem.
Yeah.
And so, in my personal opinion, is we need to do science, and what rescheduling will allow, by the way, that's probably the biggest benefit of rescheduling. It will allow federal dollars to finally flow into R&D around the cannabis plant. Because today, there is no federal dollars around R&D. This is going to be a game changer, because we can now openly do R&D working with the government on issues like potency.
I am curious. We've been talking a lot about elections, and I want to go back there. I know we talked a little bit about it with you already, but does the industry like one candidate over another? And let's assume that it is a repeat of the Trump-Biden matchup. Is there one candidate that the industry likes going into this
Why does
election?
everyone have that reaction when you
I'll tell you, because the industry is...
Or feel to write in.
The industry is just like all of us. We're Americans, and we're all tired of the political process.
Boris, I hate to tell you, we're just getting started.
I know.
Here in the U.S.
I know, we
but
are.
Is there one that is
There's no question
more
that
helpful to the
historically
industry?
the Democrats have been more favorable, but for the most part through lip service, not necessarily through action, but at least on the political side, the Democrats have been more open to try and push through regulatory change on cannabis. So yes, I think the industry would err on the side of Democrats for the most part over the Republican Party.
I always like to ask about actually using the product, CEOs and executives of companies. How do you use cannabis? What products do you use?
So I'm a user every day. I use it for sleep. So I travel a lot. I've got a lot of jet lag, a lot of stress, anxiety, being in the cannabis industry and having 5 children. Definitely adds to that. I use it every single evening for sleep, and it has changed my life.
Okay, I don't want to blow up your spot or anything, but how do you travel with it?
I just put it in my necessaire and I travel with it.
Okay. Sorry for blowing up your spot.
In the United States, the worst thing that the TSA will do to you is actually have you throw it out. That's what they'll do, right? And for the most part, though, when it comes to edibles, they don't have a problem. If you're traveling with flour or something like that, they may have an issue with it. I have found that edibles are not something that they really have an issue with.
Really interesting. Very quickly, what's the one risk to all of this? Since we have been here before, we've had a lot of optimism, only to kind of have the rug pulled out from under us.
There's 2 things that I would say at risk is, first of all, political will.
Okay.
Will they actually, is this again lip service for politics, but they won't take it to the finish line? Because what this industry is all about now is show me. It's about show me. I mean, if you look at Curaleaf went public in 2018 at a $4 billion market cap.
Yeah.
At that time, we were doing $70 million in revenue. We were going to do over $1.5 billion this year, and we're trading at a market cap of $3.6 billion. So we're actually down on our IPO 5 years ago, even though we've grown the business 15 times.
All right.
Right? So it's an amazing thing.
Is there any other risks, or did you get them all in?
I think that the main risk is a political one, is whether they'll do it. And two is, the lobbying, by the pharmaceutical industry that doesn't want to see cannabis because it is a replacement product for a lot of the pain medicines. We're doing a lot of R&D in that area in Europe. And I can tell you, we're about to launch a drug that will address pain medication out of it. We're working together with Imperial College of London on this. And it's a game changer. And that will be a big competitor to opiates.
We'll come back and talk more about that with
We'd
us.
love to.
And love to hear more about what's to come. Boris Jordan, thank you so much. Happy New Year. Good to have you back.
Great to be back. And it's good to be back in the studio.
And good to get to know the personal lowdown on how you use your products. He's founder and executive chairman of Curaleaf, joining us here in our Interactive Brokers studio.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
I don't know if you saw this news earlier this week. Did you, Tim?
I did, yeah. Axios reporting that Uber was shutting down Drizzly. You remember Drizzly? It's the alcohol delivery service it shelled out more than $1 billion for back in 2021. You can still order alcohol using the Uber app, but Drizzly will stop taking orders in March.
Done.
Yeah, that's it.
All right, well, don't despair. There are other ways to get alcohol delivered. If you're over 21, of course, one of those ways is using Reserve Bar's minibar delivery, which has been delivering booze for more than a decade.
We've got Derek Correa on with us. He's CEO of Reserve Bar. It's an e-commerce company specializing in rare and high-end spirits, and also, of course, the company that runs minibar delivery. Derek joins us on Zoom from Bedford, New York. Derek, good to have you with us this afternoon. We made a joke earlier in the day about dry January and giving up your phone for January. But of course, dry January is when people tend to give up booze. How is business? Do you notice a drop off when it comes to January as a result of dry January?
Hi, Tim. Yeah, thanks for having me on. Yeah, definitely. In fact, starting about 5 or 6 years ago, it started to be a noticeable thing. And I would actually say that it seems that dry January is becoming more popular, which is a great thing. There's a lot more beverages available to satisfy, a not drinking situation where you can still drink a quality non-alcohol beer or a mocktail. So there's a lot better options in the market now.
So how much of that you're into mocktails?
Oh yeah, I'm all about the
non-alcoholic
beer and the mocktails. It's it's kind of funny. I mean, I drink more of that than the actual real stuff.
So Derek, you sell that as well, correct?
Yeah, we do, and increasingly so. So we have those products on our platform as well. And in fact, even on an everyday basis, if you're using our platform to provision because you're having a party or you're getting stuff for your own home, we always encourage people to buy non-alcohol product as well. If you're a host, that's the way to be a good host, is to serve a great variety of beer, wine, and spirits and cocktails, but also have non-alc drinks available for your guests, many of whom who don't drink even when it's not January.
I see this at restaurants all over the city, Carol. Do you see this where you look at the wine list or you look at the beer list, and it always includes in 2023, 2024, a list of mocktails or non-alcoholic options.
Totally see.
It hasn't always been like that.
No, it hasn't. So this is where I want to go, Derek. You guys, correct me if I'm wrong, I think you started back in 2013. Is that correct?
Yeah, pretty much right around the same time as Drizzly.
All right. So tell us about that. That's a good look at kind of this market. So a decade in, how has the market changed, and what are the trends that we are seeing today when it comes to ordering this way?
Yeah, so the market grew pretty steadily and relatively conservatively for a lot of that time. Then of course COVID came along and shut down bars and restaurants, and to a certain extent even shut down retail because people weren't out. And that really accelerated the e-commerce adoption rate when, for the most part, it was the only way to get beverage alcohol. So that accelerated all the businesses, including Reserve Bar and Drizzly. And Minibar at the time was not owned by us, and we acquired Minibar Delivery during the midst of the pandemic. And since then, now that restaurants and bars are open, there's been a little bit of a cooling off. People are going back out and enjoying restaurants and bars and their favorite cocktails and drinks out. But e-commerce, in addition to the platforms, is happening in a lot of new ways. So when we saw that Uber acquired Drizzly, we fully expected them at some point to ingest it into the Uber Eats platform. That makes sense. But people are buying on platforms like Minibar Delivery, which can get you most products you could ever want in an hour. On Reserve Bar, where we offer a little bit more curated, higher-end, information-rich experience that's better for people who are enthusiasts and want to explore new bourbons and scotches and so forth. But increasingly, people are buying, they're not just shopping intentionally. That only happens about 15 or 20 minutes a day. That's when you end up on a platform like Reserve Bar or Minibar Delivery. But when you're reading an article about great spirits, or you're out and you're watching a video and it includes a great cocktail, we're creating shoppable moments in all of those instances. Because even though you weren't shopping, if you're exposed to the right product at the right moment and you can buy it right then, people are. And that's really the future of e-commerce.
Hey, Derek, so I want to go back to this idea of what Carol was talking about and the trend of what you're just seeing on the platform. I was doing some research ahead of this, and it turns out that I'm not alone, Carol, when it comes to, not drinking alcohol anymore.
Right.
So Gallup says that younger adults these days, well, I don't know if I'm considered younger adult anymore. Anyway, are less likely to drink than those of the same age 2 decades ago. So that's happening. However, older adults are drinking more. So is there this shift happening where young people aren't drinking as much and they're going to continue not drinking as much, or they're going to actually start to drink more as they get older?
That's a really interesting question. What we're seeing is people are drinking differently. I think the older people who have more disposable income are drinking better. And especially during the pandemic, we saw a lot of premiumization of, people weren't spending money at restaurants or bars. They were not going on vacation. They had more money. So they started to explore higher end marks. If they like scotch, they started drinking nicer scotches. If they drank gin, they drank nicer ones. The younger people, I think when I say they're drinking differently, they're drinking more mindfully. They're thinking more about how and when they drink. They're more dialed into calories and wellness in general. They actually drink cocktails more frequently than younger people did, even as recently as 4 or 5 years ago, when young people mostly drank beer and wine. So the things are changing. And, the nice thing about our platforms is we have an immediate view, literally day by day, minute by minute, as to what the consumer is doing, and can constantly adapt our product assortment and our tactics to those changes.
We do a beach house typically. We have with kind of our family and extended family. So it's, the kids have grown up. They're all teenagers or in their 20s and 30s. And it's just interesting. It's not beer. It's a lot of wine, but it's also a lot of cocktails that we increasingly are making. And that's what they want to make as well. Having said that, is there a core consumer that is doing the most business on your platform, Derek?
Yeah. So, we have different platforms and different people use them for different occasions and for different things, right? Minibar Delivery is perfect for provisioning your everyday products. You have some friends coming over, you realize you're out of beer or you need some vodka, you can get that brought to your house in an hour. Reserve Bar is more, you're maybe sort of just kind of flexing yourself into knowing about bourbon. And so you're coming because you can learn more about bourbon. You can, immerse yourself in deep information about distillation methods and ingredients. And that becomes, especially for the younger consumer, not only valuable on that path to purchase and that customer journey and providing that, but increasingly, beverage alcohol is a very social thing. And there's kind of social currency in knowing about tequila and knowing about bourbon and knowing how to make a great Manhattan or Boulevardier. So younger people are often coming to our platform, not just to buy, but also because it has the content they need to continue their journey of education and knowledge.
Hey, Derek, we only have 30 seconds left, and then we're going to come back. We'll do some news and come back with you. But are you seeing more growth on Minibar Delivery or on Reserve Bar?
They both, again, because they service different customers, they grow differently at different times. Reserve Bar does a lot of gifting business and corporate gifting. So it has a tremendous, October, November, December. Mini bar actually pops other times, a lot of times for parties. Like Halloween, for instance, is not a big deal for Reserve Bar, but it is a big deal for Mini Bar. So they both grow, and they grow in different ways at different times for different occasions and needs.
That's got to make it good for you, though. Like you're kind of covering, if you can cover most of the year with these two different businesses. But I want to get to some of the brands, because Tim and I have been kind of all over your platforms, both Mini Bar and Reserve Bar, and it's really quite a range and quite a variety. So talk to us about some of what you want to make sure is out there for customers.
Yeah, so the great thing about these two platforms is another difference is Mini Bar Delivery has over 3,500 retailers, and you can buy essentially all of the products that are available from those retailers. So that's kind of a max assortment, which is great. You can search for and find anything. Products are merchandised within categories. The shopping journeys are easy. All of your favorite brands are going to be there, whether it's Tito's vodka or Bullet Bourbon. And you can find some unique stuff too. Reserve Bar is more curated. So we've actually spent the time with our experts to find really the best stuff, to have a lot more information and education and intrigue in those shopping journeys for people who are more passionate, to find rare and limited products. We are the main platform in this industry for launching new products, which includes new products from all of the brands and the companies that create new brands, as well as a lot of celebrity. We just launched, the Rolling Stones have a new rum called Crossfire Hurricane.
Cool.
And that was just launched on our platform. So oftentimes you can get products on Reserve Bar that really aren't available anywhere else, including our own cask selections for those of you who are really into bourbon and tequila. We go to distilleries and pick casks specifically for us that we bottle off and have very limited quantities.
Derek, how does fulfillment work with Reserve Bar? Do you actually have the inventory and you guys are responsible for shipping it out, or do you outsource that like you do with Mini Bar Delivery?
Yeah, that's a good question, Tim. None of our platforms, and we as a company do not hold a license, so we never touch any bottles of alcohol. We don't have any inventory. We're really a technology company that has very deep technology to comply with beverage alcohol laws and to connect with our network of retailers to match you as a customer who's interested in buying something with a retailer that has that product at a good price.
So if that overhead.
If you want to buy something that is exclusively available on your platform, who then ends up fulfilling that order?
Yeah, there's certain retailers in our network that benefit from being associated with us and our relationships with the distributors and the brands. So we know that they're going to be the ones that are getting that product, and we're then able to route the orders. But
are these retailers like mom and pop liquor stores? I mean, I remember ordering a bottle of bourbon for my mom that she really liked, and the closest place it was available was somewhere in Long Island.
Nice, and Mrs. Stenovec. Yeah,
she liked it.
You're a good son, Tim.
It was something that was kind of hard to find, but it came from essentially a local store on Long Island that just had it. I don't even know. Maybe I used Reserve Bar. I don't remember.
Yeah.
But is that how it works? Like they're the ones who then ship it, and you guys don't ever touch it?
Yeah, right. So for widely available products that were available near you, if you were wanting it for yourself or near your mom, it would come from that local retailer and be delivered locally. But you get to shop a more interesting assortment that might not be available near you or a gift recipient, and we'll then ship that product to them in a compliant fashion, very packaged very nicely and safely. So that's how you can access a more compelling product assortment that you might otherwise be able to get locally.
So then as the business model, we're Bloomberg and we're always interested in this kind of stuff, so kind of getting in the weeds. So do you guys just get a percentage of the order, or do you just get a set fee on every order that's made? How does it work?
Yeah, that's exactly right. So we're basically a marketing service for the retailers in our network, and the reason they sign up with us is because we're sending them incremental orders. So in exchange for that, they give us a small fee associated with sourcing that order because it's incremental to their business. and they wouldn't have otherwise got it.
All right, tell us too about pricing strategy. And I'm going to pour a little bit of wine. You guys have been kind enough to send.
I wish I knew. I would have had my own wine as well.
I wish you had. I feel terrible. I'm not quite drinking alone, but it would be nice to have you as a part of this. You shared with us a bottle of Josh Seller's Legacy Red Blend. Looking on the website, mini bar delivery. It's about $14 a bottle. But you guys have quite a range of stuff that's out there. How do you think about price point in terms of? I'm going to share it. I'm really sorry, Derek. I'm going to share it with Tim.
This wine is a meme now. Did you know that?
I know it is a meme.
Okay.
Our producer was talking about this. One of our producers. How do you think about price point? Is there any strategy behind that?
Yeah, so one of the hardest things about operating in this industry is the regulations, federal, state, county, city, and one of those that's very clear is that retailers have to be the ones that sell you beverage alcohol, wine, spirits, beer, and they have to set the price for it. That is a universal regulatory situation. So the prices that you see on our platforms are actually the prices from the retailers in our network. And so our technology is seeing, is the product you want available, which retailer has the best price, which one is closest to you, and kind of doing all of that hard work for you as a shopper to match you with a retailer and a product that can get to you quickly at a good price.
Derek, what was the strategy of getting all these retailers on the platform? Was it old-fashioned shoe leather? Was it picking up the phones? Like it's a one-off thing. This is tough to do.
Yeah, it's all of those things. And in the early days, it was a slog. When you were calling, you would tell them you were calling from Reserve Bar, and they'd say, who? What? And you'd have to explain the entire concept of e-commerce. Nowadays, I think it's pretty universally understood. And the retailers, we are still, reaching out to retailers, but many are coming to us curious about the benefits to them and the commercial terms of joining our platform. And it is open to, expansion. And we are still in the process of adding more throughout the country.
Hey, Derek, just got about 20 seconds left here, 25 seconds. What's next for you guys? As we are going to sample the wine, and because it is Josh o'clock somewhere. What's next for you guys?
Well, what's next is what's right now, actually, which is because we don't hold a license, we're able to syndicate our technology in all kinds of interesting places. Like if you were to read an article on Whiskey Advocate about the 20 best scotches, you could buy any of those scotches right there without leaving Whiskey Advocate and continue consuming that content and also buy whatever you wanted. And we're also powering the websites of brands because lots of people go to visit sites like Hennessy.com or the Macallan.com, and they can't sell you a bottle of alcohol directly because of the 3-tier system. But our technology enables you to shop and buy because you actually are buying from a licensed retailer.
It's fascinating.
So you're going to see a lot more innovation of that kind.
Yeah, it's interesting what you guys are doing. Hey, listen, come back soon, and hopefully then we can share a drink together. But would love to kind of hear as you continue on in this business. Derek Correa, who's CEO of Reserve Bar, and also, of course, the company that runs Mini Bar Delivery.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.